On June 16th, the Bank of Japan raised interest rates again, this time to 1%. Now, if you're an American, your first thought is probably, who cares, and shrug it off. I mean, Japan is a country most of us associate with slow growth, an aging demographic, and interest rates that have been stuck near zero for decades. So, why would a quarter point move from a central bank on the other side of the planet matter to us here in the US? And the answer to that question is that there's an estimated $4 to $8 trillion trade that's underpinning global markets that depends entirely on Japan and specifically their monetary policy of keeping its interest rates lower than everyone else's. So when Japan moves or even signals to move away from this zero rate environment, like they did again last month with the rate hike, there's trillions of dollars that's been sitting in US treasuries, US stocks, and other US assets that could get unwound. So in today's video, I want to talk more about what this trade is, tell you what happened last time it unwound, and walk through why 2026 in the future looks a lot more dangerous than that previous unwinding. And then finally, how do the economics over in Tokyo affect the markets here at home? For roughly 3 decades, Japan has kept its interest rates at or near zero, and that's made the yen the cheapest major currency in the world to borrow. So here's what investors have done. A hedge fund, for example, would borrow yen from a Japanese bank at close to 0% interest. Then they would convert that yen into dollars and then use those dollars to buy higher yielding assets, things like US treasuries, US stocks, or even other currencies with higher interest rates. And as long as that interest rate gap between Japan and everywhere else stayed wide and stable, and the yen didn't move against them, that trade printed money. Think about it. I mean, you borrow at nearly nothing, you invest that money, and then you pocket the spread. This has become one of the largest and most consistent sources of leverage capital flowing into global markets. And as I mentioned during the intro, estimates put the total outstanding size of this trade anywhere from $4 trillion to as high as $8 trillion. And it's not just hedge funds that are doing this. Japanese institutions themselves, life insurance companies, pension funds, and even everyday Japanese retail investors have been sending their own money overseas for decades for this exact same reason. Domestic Japanese bonds, they've paid next to nothing for so long that Japanese savers went looking for yield anywhere else that they could find it. And a lot of that money landed in the same place, the US, through US treasuries and US equities. And so there are really two versions of this trade running in parallel. We have the leveraged, fast moving hedge fund version, but we also have the slower, but much larger unleveraged version made up of ordinary Japanese savings. But regardless of who is doing it, both depend on the condition that Japan needs to stay the cheap place to borrow and the low yield place to save. We've actually already gotten a preview of what happens when this trade starts to reverse, and it happened less than 2 years ago. In July of 2024, the Bank of Japan raised its policy rate from around zero up to about a quarter of a percent. 25 basis points, that's a small move, especially when it's an increase from zero. But it was enough to, shift the math on the carry trade, and traders that had been leaning on a permanently cheap yen for years suddenly had to reconsider their positions. And there was a pretty drastic fallout. Within days, the Nikkei 225, Japan's benchmark stock index, fell 20% between the end of July and early August. And that's its worst drop since 1987. And these shockwaves didn't just stay in Japan. US Treasury yields dropped sharply as capital rushed towards safety, and risk assets everywhere got hit. There was even a fast and sharp sell off in crypto markets as, once again, those leveraged yen funded positions got unwound all at once. Now, that was an unwind triggered by a single 25 basis point rate hike at a time when the carry trade was smaller than it is today. The BOJ has continued raising rates since then, moving well past that initial quarter point move, and the trade has grown even larger in the years since. So the episode in 2024 wasn't the worst case scenario, but it's a real demonstration that when this trade unwinds, it doesn't go quietly. So why does the current situation look even more dangerous than back in 2024? Well, it's because Japan is now running two policies at the same time that rarely coexist with each other, which are an aggressive tightening cycle from the central bank and an aggressive spending push from the government. Japan's new prime minister has pushed through a massive fiscal stimulus package. This consisted of tens of trillions of yen in spending aimed at cost of living relief, strategic investment, things like AI and semiconductors, as well as defense. Normally, that kind of spending push comes paired with a central bank holding, rates low to cushion it. Instead, the Bank of Japan is hiking, and this is because inflation has been running above its target for well over 3 years. And that combination, big fiscal spending plus rising rates, is not something that Japan's bond market has had to deal with in decades. And it's shown up directly in the price of Japanese government debt. 10-year Japanese government bond yields have climbed to their highest level in roughly 2 decades. And Japan's overall debt to GDP ratio sits near 230%, which is the highest of any developed economy in the world. And this matters because it puts real pressure on the core mechanism that has powered this yen carry trade for years. Rising Japanese government bond yields make it more attractive for Japanese investors, both institutional and retail, to just buy their own country's bonds instead of reaching overseas for yield. And we've already started to see early signs of this. In the first few months of 2026, we saw some of the largest monthly inflows into Japanese sovereign bond funds on record. And this is a signal that money might be coming home to Japan, and it's already begun in a pretty meaningful way. And if that trend continues or accelerates, this becomes a story about a slow structural pullback of Japanese capital from global markets, including US markets. So let's get real about how this actually affects you, because it really does affect you. Japan is a major player in US financial markets, and as I mentioned in my national debt video, which I encourage you to go watch by the way, Japanese investors are the largest foreign holders of US treasuries on the planet, and they hold over $1 trillion worth. This is more than any other country, including China and other European countries. And you may already be putting it together, but here's the chain reaction. If Japanese institutions and retail investors keep shifting money back toward higher yielding domestic bonds, that means less recurring demand for US Treasuries at auction. Less demand means the US Treasury has to offer higher yields to attract other buyers to fill the gap. Higher treasury yields in general, this leads to higher borrowing costs for the average person and for businesses. Think of mortgage rates, auto rates, corporate borrowing costs, not to mention the valuation math for stocks. And that last point is especially important when we're talking about high multiple growth and tech names that are most sensitive to the cost of long-term capital. On top of that, if the yen strengthens meaningfully as this unwind progresses, that removes another piece of the profitability of the carry trade itself, which then encourages even more unwinding. Now, I'm not making this video as purely a gloom and doom story. Japan does have a legitimate growth narrative that comes alongside this risk. Japanese equities have actually been significantly outperforming the US stock market over the past year and a half. Japan's Topix index has posted stronger returns than the S&P 500 over that stretch, and this has been driven by a corporate governance reform story, a wave of share buybacks, and Japan working to position itself as a significant beneficiary of the global AI and semiconductor investment boom. A meaningful part of the government's new spending package, as I mentioned earlier, is targeted at strengthening Japan's position in those exact industries. So, not trying to paint a picture of a collapsing economy. It's an economy that is trying to modernize and grow while it's simultaneously carrying enormous public debt and unwinding decades of ultra cheap monetary policy at the same time. There's another piece of this story that actually has nothing to do with interest rates or the BOJ directly. It's about energy. Japan has one of the lowest energy self sufficiency rates of any major economy, sitting around just 13%, with more than 90% of its crude oil imports traveling through the Strait of Hormuz. This makes Japan extremely exposed to the ongoing conflict in the Middle East, arguably more exposed than almost any other developed nation. And higher oil prices flow directly into Japanese inflation, which puts more pressure on the Bank of Japan to keep hiking rates, even as the government is simultaneously trying to spend its way through the same cost of living crisis that the high energy prices are creating. This is just an uncomfortable position for any central bank to be in, tightening policy specifically because of an external energy shock rather than genuine domestic economic strength. And it really adds a layer of unpredictability to exactly how fast and how far this rate hiking cycle is going to go from here. So, how does this actually play out? Well, in a mild scenario, the BOJ continues hiking, On a more gradual basis, telegraphing its moves well in advance. This allows the yen to strengthen slowly and the US markets to absorb it with, modest volatility. Maybe there's a slight stock pullback and a gradual rise in treasury yields, but nothing resembling a crisis. In a more severe scenario, though, if a hike arrives faster than expected or Japanese fiscal concerns, intensify suddenly, well, then we could see the 2024 pattern, but on a larger scale. This could look like a sharp and fast repricing across equities, a jump in treasury yields, and a scramble in leverage positions. It's really important to realize that the Japanese economic and monetary story is one that affects the entire global financial market. So here are some of the things that I'm going to keep an eye on moving forward. First is the 10-year Japanese government bond yield, because that's the single best real-time gauge of how much pressure is building underneath this yen carry trade. Second, I'm watching the USD JPY exchange rate, because a fast, sharp strengthening of the yen has historically been the trigger that forces leverage positions to unwind all at once. Third, I'm keeping an eye on US Treasury auction demand, specifically who's actually showing up to buy, because that's where we're going to see, more evidence of Japanese capital actually pulling back from American markets. That's going to do it for today's video, guys. I hope you enjoyed. If you did, leave a like, subscribe to the channel, and check out some of my other videos. Let me know what your thoughts are in the comments below. Thank you all for watching and for the support on all my videos. Have a good rest of your day, and I will see you in the next one.